This is Eddie Small from The Real Deal, coming to you live from my bedroom. Thanks for joining us for Friday's edition of TRD Talks. We're going to be doing these every Monday, Wednesday, and Friday going forward at 5 p.m. So please join us next week as well. Monday's talk is going to be about residential lending, and I'm pretty sure I'm not going to be moderating that one, so it should be very good. But for today's talk, we're going to focus on how the coronavirus pandemic is impacting the investment sales market. We're joined by Bob Knakal of JLL, Peter Von Der Ray of Marcus and Millichap, and David Schechtman of Meridian Capital. Thanks for joining us today, gentlemen. Hope you're all doing well. I wanted to start out pretty broadly. What are you guys seeing in general right now in this market? Is there anyone looking to buy or sell investment properties in an environment like this one, or is it pretty much a universal, people just holding back on deals for now?
I think folks who don't have any discretion, folks who are compelled to sell, a handful of 1031 buyers who were close to contract or hunting are some of the most important people to have at your disposal. There's a handful of bankruptcies and a handful of mandatory sales that were close. Fortunately, most of them look like they're going, but with any new endeavors and just purely discretionary sales, I think everybody's hitting pause. God bless the country, and there are things much more important than real estate and money. We hope everybody's well, but it does feel a lot like a really long August. It feels like the last 2 weeks of August, and it feels like it's going to be this way for a while. Some people are going to be there, and others just won't. But we have a lot of sellers, and I trust my colleagues online with me here. We have a lot of sellers who have just said, we're going to get realistic. We have a mandate to sell. We're going to take the necessary hits, and please find me a buyer. So it is business as usual, subject to extraordinary events.
Got it. Bob and Peter, would you guys agree with that? Like, unless someone is, for whatever reason, essentially forced to do a deal right now?
I would say that the way we're seeing the market, I just looked and grabbed some numbers right before the call. And since the world effectively, went into quarantine about 2 weeks ago, we've closed 3 transactions, we've put 6 under contract, and we've listed 6. And so if you had to categorize how the market is responding, if you had a deal that was going to close or just about to go under contract, since that time we've had, several people who've said, I want to actually do something. Those are the areas where you're still seeing activity. I think the dead zone in the market is if you've been on the market for 3 weeks, or you're in the middle of marketing and you're not at the point to do anything. Now the world changed, the pricing changed, and that's where the dead spot is in the market. As David said, the ones we've closed, some have closed, some you had to take a little haircut, and putting under contract and stuff like that. So that's where we've seen the dead spot is where you were already in the marketing phase and the deal's on the market, and now maybe the world's changed and we've got to go back and say, is the pricing going to change? Are buyers going to look at this differently? And how do you do a showing when you can't see when you have to stay 6 feet away from everybody?
Yeah, and Eddie, I'd like to back up and just get a little bit more macro from 40,000 feet, because looking at how the investment sales market has been performing, and let's go back, the peak of the cycle was clearly 2014 and 2015. The volume numbers have been dropping since then. We got a little bit excited in the fourth quarter of 2019 when we had $9.5 billion of sales volume in Manhattan for transactions over $10 million. That was, we thought could potentially be the start of coming out of this correction phase that we've been in for 54 months now. We were very clear to say one quarter doesn't make a trend, but that $9.5 billion spike in activity in the fourth quarter made us feel very optimistic coming into the first quarter. If we look at the first 10 weeks of the year, and quarterize those numbers and then annualize them, we're on pace for about $20 billion in sales this year, which would be down 30% from the $28.7 billion last year and down 65% from the $57.5 billion that occurred in 2015. On the number of properties sold front, there were 26 sales over $10 million in Manhattan in the first 10 weeks. That's on pace for about 124 sales. That would be down 34% from last year and 74% from the peak. So, and none of that data, or virtually none of it, was impacted by what's going on now with the virus, because most of those contracts were signed in the fourth quarter of last year or very early first quarter of this year. So that is a bigger concern to me. And without making any commentary about whether this corona impact is going to be short-term, medium-term, long-term, however long, it is viewed, I think, by most people as a temporary thing for the most part. But the fact is that the underlying fundamentals in the market have not really been working with us as intermediaries. And that's more of a concern, I think, than anything that could be temporary.
So it was already a pretty tough market for investment sales prior to the pandemic hitting, you're saying?
Well,
the
in
market was still
2015, there were 481 sales in Manhattan over $10 million.
Yeah.
We're on pace for 124 this year. We, as intermediaries, David, Peter, and I, we need action. We need folks who want to sell that will capitulate at the market price. We need people that want to buy and that can get financing to effectuate those purchases. And, I think that, getting back to your initial question, I think there are certainly motivated sellers and there are motivated buyers, but getting them on the same page and getting them to agree at what level to trade at is really the key to our business. And I think that right now you have very, very different dynamics in each of the product types. Multifamily is behaving differently from industrial, from office, certainly from retail. So it really is dependent upon what product type you're talking about, what location you're talking about, the specifics of that particular asset within the asset class. Are rents above market? Are they below market? Are they long-term? Are they short-term? All of these things come into play, and we're really in price discovery mode now, again, as we have been in the multifamily world for quite a while, since June of last year. But now we're kind of in price discovery mode on every asset class and every type of property. So, it's a very, very interesting time, and probably more important now than ever to really focus on what folks are saying, what their sentiment is, what they're bidding on, how they're bidding, why they're bidding, and really being in tune with the market is probably more important now than ever before.
And what are you guys doing, and I guess how are you trying to keep people interested in buying and selling properties in what's, a pretty unprecedented market that we've just recently entered in?
Well, that's actually pretty easy. What I'm finding is I'm forcing myself. I have a clicker at my desk, and I have for 15 years. I'm forcing myself to try and make 50 outgoing phone calls a day. I will tell you, since everybody's phones are going directly to their cell phones, I've probably had a greater realization rate on getting people on the phone. I've been collecting some of those comments in anticipation of this. And I think that when you talk about multifamily and keeping interest, one of our portfolio lenders at Meridian just texted me right behind the call, before the call. Make sure you let the viewers know we closed 20 portfolio loans in the tri-state this week. Obviously, I can't plug who specifically is, and we're open for business. What he said he's concerned about, and the sentiment that's shared with the multifamily people, and this, by the way, is tri-state, not just limited to New York, and I'd say up and down the 95 corridor where we have action, I think people are really keeping an eye toward collections. I think everybody expects that their April rents are going to be paid. If you're talking about multifamily and you're talking about workforce housing or stabilized housing, the good news is we had a $2 trillion bill that's going to allow, hopefully a lot of that money will go to rent. But I think the May, June collections are going to dictate sentiment in the multifamily arena. Industrial, I have not seen slow at all in the past 2 weeks. When it comes to retail, I think fortunately or unfortunately, with the innovation of new technology, there was a paradigm shift which started 36 months ago in earnest. I think that hotel is the one food group that is simply going to be decimated. And I think the major activity in hotels is going to come in the form of loan sales. But when you talk about the other food groups, industrial, multifamily, retail, and office, I think you're going to continue to see activity. It's just a question of how open for business are the banks, and all of them are saying we may have to hit pause for a few days, but we still have money that we have to put out.
When you said hotels in particular might be decimated, like, is that permanent? Like, would you, I mean, eventually, hopefully at least this thing passes, like, are hotels just kind of a toxic asset class for you at this point? Like, would you expect to be able to sell them once life gets back to normal? Or do you think this pandemic might just cause some damage to them that's too lasting for you to be able to dive back in?
Well, I think history is
I think
best. Yeah, go ahead, Bob.
No, David, go ahead.
History is our best teacher. Having lived through a handful of cycles and then just looking back, when you talk about 29 or the 1929 or the late 70s, 80s, and then again 2001 and 2008, this running and saying that something is a dead asset class is just a silly notion. It's a question of time. Sticks and bricks are where people are going to run in times of global crisis. And when you talk about major CBDs, New York, San Fran, and so on and so forth, yes, you have technology that hurt it, you have Airbnb that hurt it, and now, unfortunately, we have hundreds of thousands of people, many of whom are unskilled, who are suffering tremendously. That's going to hurt hotels. But if you're telling me that you've got 100,000 square feet in the West 30s a year from now, and unfortunately they can no longer fly a flag, well, the good news is those hotels can be repurposed, and at some point tourism's going to come back. One thing that I'll say before I cede the floor to my colleagues is I'm very proud of the real estate industry, not just in New York, around the nation. We have the Four Seasons has opened itself to the laborers and our healthcare workers. We have the White Hotel in Brooklyn that is a $400+ a night ADR that's opened itself up. And you're seeing this story repeat itself throughout the country. Today it's going to be populated by people who are using it for triage. And I bet you in 6 to 12 months from now, you're going to log on to Expedia and you'll be going down to Florida, staying at the Eden Rock for $199 a night. And it's going to come back. It's all going to come back.
Yeah, David, that's the point I was going to make, is that you can't really write off any particular asset class or type of property. The market always has been, is, and always will be cyclical. And at different points in time, different types of product does better than others. You look at some of the buildings that were built as apartment buildings in the 1940s and 1950s, and in the 1960s, they were converted into office buildings. And then in the 1980s, that office building was converted to a hotel. And then, at some point, that building is going to be converted from a hotel to a residential condo. So the evolution of what is the in product type will constantly change. Nothing is great forever or dead forever, but you have to constantly adapt to what is the sector of the market that is doing the best at that particular time, and that comes and goes in waves, and always has and always will.
One of the bigger stories just this past week in the iSales market, obviously, was Schechtman pulling out of his $815 million agreement to buy the Dealer News building from SL Green. How big of a deal and how big of a concern is that to you guys? Do you view that as, a very unique case and kind of a one-off, or is that, a sign of things to come? And would we maybe see more, major deals that are in contract fall apart given the market that we're in now?
Well, I think that's an extreme case, but if you look at what the stock market has told us, the markets are basically telling us that we're in a recession. And the question is, how deep is this recession and how long is it going to last? And what's interesting is that because the stimulus packages that were used in the Great Recession, the government was able to essentially take those off the shelf and repurpose them. So we've seen the stimulus that's come out in response to this crisis has come out a lot quicker. But with what's happened with the financial markets, there are tremendous questions in terms of the financing capabilities, what you're financing. The financing markets are moving around a lot right now. So those no longer are given. A lot of equity commitments are totally different. So, so I think it's just, and obviously that's a very big deal. It's, so that's, you're going to be at the high end of the things that are going to be moving around there. So the market, this is changing the markets in all aspects of them.
Eddie, just to follow up on that question. Go ahead, Bob.
We'll let Bob go first.
All right. Yeah. So I was just going to say that, when times are good in the real estate industry and you have a transaction that's under hard contract, the default rate is virtually zero. The transaction will always close one way or another. And when there is a disruption of some type, whether that's a recession, whether that is a credit crisis, whether it is something that changes the norm, the possibility that a transaction under hard contract doesn't close goes up a little bit. And at different times, that rate of default will change based upon how profound that disruption is. And I think that it is way, way too early in this process to kind of draw any conclusions whatsoever in terms of how that one particular transaction might impact the market moving forward. It's way too soon. It's not statistically significant yet. And there's nobody in the world who knows how long, how impactful, how deep this current situation is going to be. It's literally changing day to day, hour to hour, and it would be foolish to try to draw conclusions from any one or two data points in the market.
Eddie, to that end, when you talk about defaults, and I concur completely with Bob, this is a nascent new phenomenon and an unfortunate series of events. We had a deal that was supposed to go to contract last week. It's a $10.1 million multifamily deal in the Bronx, a discretionary generational seller and a family-type buyer. The buyer called up and asked for a conference call with all hands, lawyers and the brokers, we represent both sides, and the principals. And the buyer said, look, I'm paying 10.1. I'm not going to candy coat this. I have buyer's remorse. I'd like to own the asset, but I don't know what it's worth. I don't know if it's a falling knife, and I'm candidly concerned about going hard on the deal. I would feel better, and I always like the deal at 9.5. The seller said, well, thank you for being so candid. You haven't signed anything yet. We've also given it thought, and we're very eager to sell as part of our estate planning. They met at 9.75, and they also decided to hasten the closing after speaking with the bank, who said the proceeds are still ready. I think you're going to see a very fluid situation. And, I would just implore both sides and all real estate professionals nationally, make sure that we're in constant contact. You're going to see banks bending over backwards because they want to stay in the business of business. And sellers recognize that there was a paradigm shift in pricing anyway. But as far as an empirical data point, one major sale with that aforementioned family, I don't think we can extrapolate too much from it.
Did you see similar, like Bob, you had mentioned that, defaults tend to happen more often in more challenging markets. Did you see similar things happen after events such as, Hurricane Sandy, the 2008 financial crisis, 9/11? And then off of that, just acknowledging that we're still early in this, how does what's happened so far compare in general to, some of the other challenging markets that you faced throughout your careers? Like how does this current market feel compared to some of the past ones?
Yeah, Eddie, I think that this is, again, we're way early. I mean, in some ways, I feel like we're still in batting practice. The game hasn't really even started yet. Yeah. It's so early. But, clearly the recession from 2007 to 2010 was very, very significant and impactful. We saw a significant reduction in volume of sales. We saw average values drop by 38% from peak to trough. The recession that we went through in the early 2000s with the credit crisis, at the time, we saw a volume drop, but we never saw a value drop during that recession. So that was one in which the investment sales market in New York City was not highly correlated to the broader economy at all. And then I go back to the S&L crisis in the early 90s, which was by far, I would say, 3 or 4 times worse than the Great Recession that we had, 07 to 10. At that point in time, we saw the volume of sales down by 90%. We saw values down 58% from peak to trough in the early 90s. The same buildings that I sold for co-op conversion in 1987 and 1988 for 10 and 12 times the rent, I sold for 2 and 3 times the rent in 1992 and 1993. I mean, that was absolutely abysmal. And that also happened very, very quickly, such that a very small fraction of the deals that were under hard contract going in to the S&L crisis actually closed. And the market was frozen for almost 18 months as everyone was trying to figure out how to get things done or what was going to happen. The RTC was formed, and then the floodgates opened when the RTC just started taking over assets from failed banks and seemingly dumping hundreds every week on the market. And that was the best buying opportunity I ever saw. No one had any money. And there was a ton of properties available for sale, and lenders had to finance a lot of them in order to just get them off the books. So I think every disruption occurs differently than previous ones do. Sometimes they're correlated to the broader economy, sometimes they're not. This disruption is far too early to try to draw any conclusions about. It's, as I said, constantly unfolding on, almost an hourly basis, and all we can do is monitor it and try to adapt as best we can.
I mean, I think, though, you can draw some conclusions here because you've seen massive unemployment happen in just a week. And, a lot of the other disruptions that we've had in the market, like some of the other crises were financial crises. They were systemic crises. This is more like a hurricane that hit the entire country, or maybe is hitting the entire world at the same time. The other thing is, that has come up a lot in conversations this week, is if you look at like the recession, the 08 recession, the bartenders, the servers, there were parts of the economy where these people still held their jobs. And during this crisis, everybody's wiped out. So everybody's impacted in different ways. I think you can we've seen enough data over the past couple of weeks that you can draw some conclusions. And So.
Peter, I think there's one other distinction. When you look at those aforementioned crises, very often the banks shut down. I remember in 2009, being laughed at early in Q1 of 2009 when we would have a handshake on a deal, just searching for a bank to put out money for a construction loan. I think the difference now, and in fairness to Bob, it's still week 3 or 4, but I think the difference now is real estate as a commodity and as an industry is viewed much differently than it has been. It's a lot more institutional. And I think that the banks remain open for business because heading into this crisis, we've had historically low rates across the board for all product types. You have cost of equity for most institutions had really lowered from the teens to single digits. So what you're sitting on now is banks who want to remain open for business, many of whom are at the moment. You have a ton of pent-up equity. And while you have horrible, tragic events nationwide, you have a market that wants to transact and wants to get through it. And it recognizes that while it's a pandemic, people are going to transact. But Bob's right. We need to get out. Right now we're up to our ankles, up to our knees. Let's talk when we're in the really deep water, up to our necks.
Yeah, for sure. For sure, if you look at pricing, I think the big opportunity today, if you had to categorize the market, is it's a big opportunity for private capital right now. A lot of the institutions now are going to have to rebalance their portfolios, and private capital can move quicker. And that's, at least in the short term, right now, because I agree with both David and Bob that we're not going to really be able to describe this thing until we're months into it. But at least if you talk about today, immediately today, private capital can act very quickly. And that's probably the biggest opportunity for them that they've seen in a while.
We've mentioned the $2 trillion stimulus a few times. Obviously, that just passed today. Can you talk at all about what you think that's going to mean for the investment sales market? Would you expect to see any impacts almost immediately, or do you think it's going to take a little bit longer to have an effect on what you guys do?
I think, Eddie,
Go ahead, Bob.
The answer to that really is going to be dependent upon, how it impacts rent-paying folks and entities. What is the direct impact that it will have on the people who make decisions about whether to pay their residential rent on their apartment, or a store paying rent on their retail space, or an office tenant paying rent in their building? How is that the stimulus going to help folks feel confident and comfortable to go ahead and meet their obligations? And that's really the key, is how effectively that money will be used to normalize the situation as much as possible. And that is TBD. Let's see what happens. But, a lot of folks, are curious as to what type of rent collections they're going to have in April and May. And that is also TBD. Hopefully, the stimulus will encourage a greater percentage of folks to meet their obligations.
But, there was page 220 of the package, and it's wonderful when you have to wake up at 4 o'clock in the morning to walk the dog what you read. Page 220 has this depreciation rule, which I think, and I'd like to speak more with the accounting world and see it not just read but applied in practice. But we're talking about removing the cap on depreciation. And I hope that there's more in the bill, but the thing reads like the IRS code. You're going to have people who are going to be able to write down some of their losses, carry them forward ad infinitum, as opposed to the previous $500,000 cap. I think the bill is going to be good in the short term. I think the real question, like Bob says, and the touchstone that I'm hearing on the call is collections. From the accounting firms to the retailer to F&B and to workforce and regulated housing. I think that's really going to dictate what the market does.
And then obviously, I mean, we're pretty much all shelter in place now, or I guess we're not supposed to call it shelter in place. It's New York on pause, but, not really supposed to be leaving our houses and just, limiting social interactions as much as possible. In terms of investment sales, in terms of just closing deals, how big of a hurdle is that for you guys? Like how much tougher has it made your jobs to have such strict limitations on being able to meet people in person?
I think obviously for walking multifamily buildings, it's a major hurdle. We've already had a lease review for a 100-unit multifamily building in Queens, which was fascinating. It was the manager's office. What he actually did is he met an attorney and the buyer himself outside the office. They didn't shake hands, of course. He let them into the office, which was otherwise vacant. They did a review. Obviously, this conforms completely with the law. This was before the order was in place, but they did their review. They locked up behind them and they walked out. So they did do a physical review. It's obviously a major hurdle, but I'll tell you, when it comes to showing either a retail space, many office buildings, and certainly development sites, there's absolutely no hurdle whatsoever. It's also wonderful that this time, unlike past crises, technology has evolved. I could tell you what all the apartments look like in several of my clients' buildings without having ever entered them myself. My team does, because they're all on StreetEasy or various other websites. But overall, not meeting in person, it's beyond a nuisance. It's definitely going to be challenging.
Yeah, are you setting up like virtual tours of the buildings or anything like that? Is that something you can do these days?
Well, you can't have anybody in the buildings. So we want to comply with the laws completely. But Peter's a great person to ask that, because he's a guy who I've known over the years. As I've walked into a building, he walks out, and he's got thousands of units. Peter, what are you going to do?
As far as your question goes, I think it's been interesting because the industry has reacted very quickly. Like you said, if this had happened 10 years ago, before a lot of the technologies that we have, just the fact that we're on this call having this discussion, so it's incredibly disruptive from a day-to-day standpoint, but we have a lot more tools now than we used to. And, so it's, people are making the best of it. And I have to say, based on my read on it is that we're doing better than I thought we were going to do.
Do you think any of these limitations now could lead to broader changes in terms of how you guys show buildings or market buildings, or at least in terms of, social interactions? Would you expect things to revert back to normal pretty quickly once the limitations are lifted?
I think every business that goes through a period like this, you strip down to what's essential, and you also develop new muscles that you use during these times that end up becoming much more valuable when you come out of them. So I think there are definitely, ways we're communicating, ways we're working together. I had a client yesterday who owns 40 buildings in the city say, I've been doing Zoom meetings all week and I like them so much, I'm not going to have in-person meetings anymore because they're more efficient and I like them better. So I think there's going to be several things. It's a little early to exactly pinpoint what they are, but I think there are going to be several things that are going to come out of this that we're going to look back on and say, because of what we went through with the coronavirus, we now can do, X, Y, Z.
Yeah, I think we'll bounce back to the old ways fairly quickly. I think there's no replacement for good old face-to-face contact and getting together with somebody. I think it's a lot harder to convey a lot of things virtually. People have spoken about doing virtual tours of properties and things like that. I'm not sure what the efficacy of that type of thing would be relative to actually getting out there and kicking the bricks, as they say. But I think that once we get back to having the ability to behave, quote unquote, normally, I think it'll get back to the old ways very, very quickly. And, as Peter alluded to, you do what you have to do when you have to do it. We all, try to do the best we possibly can based upon the circumstances that we are operating under. And we'll continue to do that, try to be as effective as we possibly can. But clearly, these circumstances are not ideal.
And then I wanted to touch on the multifamily market specifically for a bit, just because sales in that asset class were already at historic lows before the pandemic hit, which obviously real estate is mostly attributed to the rent laws that Albany passed last year. Is this pandemic sort of like just the final nail in the coffin for the multifamily market, or do you still see it rebounding, or at least for market rate properties, or just across the board?
I think it's interesting right now because rent stabilized property typically was a recession hedge. And so you would see an increase of interest in stabilized buildings because the rents were, obviously protected and below market. And so you were kind of insulated from things that may have been occurring in the economy. What happened in June is it took away a lot of the upside, all of the upside. I see you smiling when I said that, Eddie, but it took away all of the upside.
Sorry, Peter, I was actually smiling because I just took a quick look at the Q&As we've been getting, and one of them was, does David wear a suit and tie at home?
I'm not wearing any pants.
That's what the smile was for. But anyway, keep going.
That's good. That's good. Yes. I was waiting till later in the call to work David's tie comment in. So we'll get to David's home wardrobe later. But so I just think that's interesting. The one thing we've been talking a little bit about is that I think the disruption in the economy it's going to cause some people who want access to capital. And so that may bring some property to market. And also, if you look at what happened in the stock market, for example, I know it came up the past couple of days, but the stock market at 18,000 looks a lot better than it did at almost 30. And more broadly speaking, for owners who have other investment alternatives that are not priced so high, they may look at themselves and say, with the rent stabilized law where I don't have as much upside, maybe there are better places for my capital. This is just, these are ideas, we have to see them play out. But, the confluence of what happened in June and now the coronavirus and how it relates to multifamily and stabilized in general is going to be interesting to see how it plays out over the next couple of months.
Yeah, and I think interestingly, we met with a family that owns a portfolio of multifamily properties, gave them a valuation on about 10 buildings. And in the meeting, the owner had given us or brought out a valuation that we did on the same portfolio of buildings 8 years ago. The values were essentially the same, but the net income on the property was up slightly, even though the gross revenue was up significantly. The real estate taxes were up 150% in 8 years, which was just unbelievable to take a look at. The portfolio was partially regulated, partially free market. 8 years ago, we used a very, very low cap rate on the rent stabilized and a higher cap rate on the free market. This time around, we used a higher cap rate on the rent stabilized and a lower cap rate on the free market. And at the end of the day, adding all those things together, the value was up maybe 5 or 10% from where it was 8 years ago. But it's just remarkable to take a look at that to see how the gross revenue was way up. Real estate tax increases ate up most of the increase in the gross revenue. And now our cap rate allocation had completely inverted, where the very low cap rate we used on regulated units back then was now much higher than the cap rate we used on the free market units is really interesting to see how the market has shifted, and it will continue to shift. And again, it's a learning process that we all go through every day, every week, every month as we're looking at properties, seeing what's selling, how investors are looking at different types of properties and how they're underwriting different upside, different risk, things like that. But that was such an eye-opening thing to take a look at how different things were just 8 years ago, which is really not that long a period of time if you think about it.
And Eddie, to put, along the lines of what Bob said, you have to also think of real estate. While there's people's lives and workplaces and homes that are involved, they're ultimately a commodity in many ways. And oftentimes people sell not because it's the height of the market or close to the market. You have different life cycles. I'm working on a smaller deal, an $11 million deal in the West 20s right now. I even admonished the family that we should wait a couple of weeks. I've known you for 12 years, and I sold you the darn thing in 2007. And their answer was, this is an estate planning issue, and things go up and down, and our basis is X, and we have to sell. And there are funds that have certain lives, whether it's 3 to 5 or 7 years. And then you look at some of the REITs right now who are saying, okay, overall, there's going to be dispositions. And we realize that some of them may be at a loss. When you think about a fund that has $1.5 billion and that owns 20,000 units nationwide, if they take a hit on part of the fund, but they've realized gains in other parts. So it's just a question of volume. And as Bob said early on, we as brokers never want to see anybody hurt. The greatest thing in our business is to have all parties walk away from the table. The buyer thinks that he has upside. The seller thinks he sold at a high price. And we, the brokers, get a commission and the banks get to put out money. But that's not always the case. A lot of times people come to the table and just say, it was time for a disposition for whatever reason. And you're going to see volume. You're going to see it. We don't care if we're selling on the way up or the way down. We never want people to get hurt as long as we're transacting. And the transactions are going to come back.
Then I wanted to talk about layoffs a bit. And Peter, I wanted to start with you because we got an email from Marks and Millichap yesterday basically saying, they haven't let anyone go yet and they're still recruiting heavily. And, they got some of their best players that they have now in the wake of the 2008 financial crisis. So I was wondering if you could talk to us a little bit about the recruiting efforts Marks and Millichap is going through now, and then just all of you in general. Are you concerned about layoffs in the commercial real estate industry given the economy, or does it feel like a, relatively immune sector, at least compared to what we've been seeing in, places like retail and hospitality?
I would say when we started this, Bob was rattling off the statistics of the sales velocity since 2015 to 2020, and it had gone down and down and down. So our industry has been thinned out a lot over the past several years. So it's not like we're coming into what happened with the coronavirus very bloated. So that's my take on it, is that, I think everyone's going to make adjustments that they need to as this plays out. But as far as the New York, and this is the New York City market, the rest of the country has been behaving, completely differently than New York, especially over the last 3 years. So some of the markets around the country have had their best sales, their best sales volumes in history, all over the place. So New York has been very different in that capacity. So, that's my 2 cents on it.
Got it.
Yeah, I think interestingly, we were on a sales call this morning, and we heard a presentation from Rod Santomassimo of the Massimo Group. The Massimo Group is the premier broker coaching company in the country. And one of the statistics that he threw out this morning was that there are about 83,000 brokers nationally, commercial brokers, that is, and the expectation is that that number could drop to as low as 60,000 brokers, which is not atypical. Typically, when you have a situation where volume drops, normally that process weeds out mediocre brokers or brokers who are not, very, very active. And so unsure, personally, I'm unsure what the numbers might look like, but anytime you have something that exerts downward pressure on the transaction volume, you're going to have a smaller arena of people who are doing that particular activity just because there's less of that activity to go around.
David, any thoughts on just layoffs in the industry? Are they coming, or are you concerned about them? Or
I think layoffs are coming in the industry, and industry gets wounded, and as lean as ships are run, and I'm not speaking about my shop in particular, which runs everybody works really hard. I think that you're gonna see layoffs, and I think it's gonna start oftentimes. Some of it's going to be discretionary. If you have a neophyte who has other alternatives, and you've got a young guy or gal who's 25 years old and is saying, boy, there's going to be incredible headwinds and I just can't afford to be a neophyte in this industry now, they have optionality. They likely don't have families yet, and they can pivot. And, I would encourage those people to stay, because this learning experience and weathering it is going to really set them up for success when we have an ascending market. I'm sure there's salaried people throughout the industry who are unfortunately going to feel pain. An industry contracts, you're going to have pain. I know that Ralph has been telling our folks, and we have several times weekly, we have some all hands, and God bless Zoom. It's just an incredible thing. We have meetings, and we've got to be like the U.S. Marines. Circumstances change, and you need to overcome, and you need to adapt. But unfortunately, yes, I'm sure there are places in the industry where people will lose their jobs.
All right. I wanted to take some time to answer a few of the questions, or to ask a few of the questions that have come in, and not just about David wearing a suit and tie, but I've gotten some other ones as well. One person is asking, in the last 12 months, expenses grew faster than ever, and income grew slower than in recent years. With collections down a few percent, a lot of buildings will be worth less than the debt. How will these owners be able to sell?
It won't be the owners who's selling them. This is, my background is in bankruptcy law, and in 2008, 9, and 10, 80% of my business, and I was still a little bit green at that point, chasing Bob and mirroring what he was doing and emulating his good work in down markets. But the sellers are going to shift. We already have a situation which I think we're going to work out next week. We have a seller who recognizes his equity has largely been wiped. He's being paid equity. He's probably being paid about $900,000 to walk away from a deal, to stave off foreclosure. The bank's going to see about 102 cents on the dollar on their note with protective advances. So I think our sellers are going to shift. You may not have sellers all the time as discretionary sellers. You probably will be dealing with their banks in concert very often. I know in the resi world, nationally, we call it short sales. There's going to be some structured sales, and I think there's going to be some equity swaps. And notwithstanding the fact that, yes, we have a preposterous headwind in the form of ill-advised legislators who've demonized real estate and increased taxes. You didn't think I wasn't going to get that in, Eddie. I think those legislators are going to have to realize over time that you can't kill the golden goose, but your sellers are going to be working in concert with their lenders. And to their credit, the lenders have been ready for this. They anticipated it. I would never wish the ill-advised legislation that was put in place in June in any country or in any forum on earth. But the fact that we've already crossed that hurdle and we had any activity after June, I think it speaks volumes to we will transact under this new paradigm as well. We've already had a warm-up in the form of June and July.
We had another person ask, any thoughts on how this might impact co-living and co-working?
I like to quote Ofer Yardeni, and Ofer, don't be mad at me if you ever see this. But very early on, when we talked about co-living, Ofer said, "Boy, by the time I got to my late 20s, I didn't want to live with any kids. I wanted to be a grown-up." So now the idea of turning around and going into a shared apartment is crazy. I don't get it. Whether that's right or wrong, I think co-living, as technology evolves and as the millennials gain more and more money, I think it'll be with us forever. But I never believed in it to the extent that people have touted it. This is not Japan. We don't live in pod apartments. And as hip as Brooklyn has become, you'll always have a Craigslist type environment. You'll always have people sharing apartments. But I never thought it was going to have significant market share in New York.
Do you think the pandemic? Oh, go for it.
No, I was just going to say, I think time will tell. Mm-hmm. This will be a big test for both of those businesses, co-living and co-working, and how well an industry or a sector responds or rebounds will say a lot about the longevity that it will have.
What about traditional office buildings with everyone working from home now? Is there any concern that, once we come out the other side of this, some companies might decide they, don't need the big office anymore? They'll maybe scale back on the amount of space they were using in traditional office buildings, or do you see it kind of rebounding to where it was before?
I think people come back, but I think Regus is a great company to be invested in. I think you're going to see a lot more optionality, and unfortunately, we're going to have some businesses that are suffering, and I think you're going to have business owners looking at each other saying, "Hey, you live on Long Island, you live in Bergen County, you live in Queens, and I live in Westchester. Let's scale down our office and move to some kind of co-working platform as technology evolves." So my answer is 100% polar opposite of co-living. I think co-working will continue to grow, and I think it's going to grow materially. It's a shame that SoftBank and WeWork just grew too quickly and didn't capitalize appropriately, because I think that market is going to go no place but up.
Right. We are getting close to running out of time here, so maybe we'll end on this one. Somebody asked, what do you guys think is the best market for investment sales brokers today and moving forward?
Well, I'll start with that one. The best clients for any of us are the folks who absolutely have to sell at a market clearing price. One of the fundamentals of this business is to always look for motivation that people have to do something. If a property is worth $50 million and somebody says, "I really, really, really want to sell it, but I need $60 million," they don't really, really, really want to sell it. Why is somebody selling? What decision have they made about why they want to sell, and will they sell at a market clearing price? And that's one of the beautiful things about New York, is that there is always a market clearing price, whether we are at the absolute peak of a cycle or we're at the absolute bottom of a cycle. There's always 50 people that would buy any building in New York City. And so we can make a market, whether the market is good or the market is bad, there's a market out there. And if someone wants to sell at a market clearing price, that can easily be done. So the question becomes really, what is the motivation of the seller? Are they willing to be realistic? Why do they want to sell? What's motivating the decision? What's inducing them to make the decision to sell? And looking at that very, very basic fundamental thing is the most important thing to look for when market conditions aren't as great as we would like them to be.
It's making me, when you asked that question, it reminded me of a phrase in the industry that we all probably have heard, which is, when the market's bad, it's bad. When the market's very bad, it's good.
I think that's right. You're going to have a lot of people who weren't discretionary sellers. And I think what's interesting about when you have non-real estate forces affecting real estate, oftentimes the three people on this call and all of our teams, we spend a lot of time educating people. But I don't need to get on the phone and educate Andrea and Leslie Himmel. They have data that rivals mine. They know where the clearing prices are when they're going to sell something. Our jobs are to educate that gentleman in Maspeth who's owned his warehouse for 40 years and has some lower level brokers giving him pie in the sky numbers. We spend all of our time showing him empirical data and sentiment to explain to him why it's 50 and why it's not 70. Now, unfortunately, and none of us wish it on us, we have other forces. They can pick up the New York Post and realize, wow, I'm never getting 70. Maybe that broker was right. And if they call you up and they say, I've seen what's happening on Earth, it's time for me to go. Well, that's what we all compete for, to control the rational seller and willing seller. That is the zenith, the pinnacle, the golden chalice.
Got it. Well, golden chalice is a pretty solid phrase to wrap things up on. So just want to say thanks once more to David, Bob, and Peter. Again, we're going to be doing these moving forward every Monday, Wednesday, and Friday at 5 p.m. And this is Eddie Small from The Real Deal. Please check out our website, our app. You can subscribe for even more great coverage and more great insights from people like David, Bob, and Peter. So guys, thanks again. Hope you're all doing well and staying healthy. And everyone, thanks for watching.